Hello and welcome to the lecture for week 5. In this lecture, we'll talk about fraud in the workplace and internal controls. Really important subject. Your textbook defines fraud in the workplace as fraud can be defined in many ways, but for the purpose of this course, we define it as the act of intentionally deceiving a person or organization or misrepresenting a relationship in order to secure some type of benefit, keyword either financial or non-financial. So fraud takes place in two different ways. One is what we normally think of as fraud, which is embezzlement, somebody taking assets, primarily cash, from the company and taking it as their own property, stealing it. The other type of fraud that can take place is misrepresenting results due to pressure. So as an example, you may work somewhere where the boss says, if you don't earn a profit, I'm shutting the whole thing down. Well, that kind of pressure to save your job and those of your coworkers can result in creating fraudulent financial statements, recording transactions that aren't truly transactions, that sort of thing. That's also a type of fraud, but it is what they refer to here as non-financial in the sense that you're not stealing money. One diagram that really changed my view of internal controls, I used to think it's kind of a petty list of rules that had to be followed and that it kind of inhibited uh, growth and innovation in the workplace, that sort of thing. And this diagram really changed it for me. It's called the triangle of fraud, and I've heard different words used in different sections of that, but it's a way of looking at the workplace and determining whether fraud is likely to occur. I want to talk about each of the three corners of the triangle. First is incentive. That could take a couple of different forms. It could either be some severe financial crunch that an individual is under. Maybe their spouse has lost their job and they're at risk of losing their home, that sort of thing. It could be that their child needs experimental medical treatment that insurance doesn't cover. There could be completely justified reasons for them needing money that they don't have. That's one type of incentive. Another type of incentive is what I talked about earlier, which is pressure in the workplace to perform. And that pressure could take one of two forms. It kind of a carrots and sticks approach. So it could be that if you do X, Y, and Z, you get an enormous bonus. You get a financial windfall that creates pressure to achieve those results. The negative side of that can be, we'll fire you if you don't make these results. So you're falsifying records to justify your job and to keep it, that sort of thing. So employees or companies with that kind of an atmosphere are going to be more prone to having fraud in the workplace, where they create a large amount of pressure on their employees. Rationalization is the way people come to what they tell themselves to feel comfortable with what they've done. I think most people understand that it's not right to take something that isn't yours or to create false documents and that sort of thing. So the way they rationalize it is how they become comfortable with doing that, how they normalize it. In my years in private industry, I caught multiple people, managers and more lower level employees, committing fraud, stealing from the company. And the most common rationalization is that I'm underpaid and it's only fair. I'm just making things right by taking this. So it's your fault that you're not paying me enough. That sort of rationalization. And it's important to keep in mind that we can't, as employers, do much about the bottom two, right? We can't control what somebody's personal financial situation is, and we can't control what people tell themselves in their own mind. What we can control is perceived opportunities. If we leave cash laying around, it's going to get stolen, right? That sort of thing. So how can we look throughout the organization and create procedures and policies that make it difficult to commit fraud, make it likely that you're going to get caught? I view it as kind of helping people stay on the right path, right? I don't think anybody wants to commit fraud and get caught and suffer the consequences. So how can we engineer the workplace in a way that removes that temptation and keeps them from doing something that they're likely to regret. So there are 5 different areas of internal controls that I want to talk about. Uh, since the failure of Enron, which most of you have probably heard about, there's a lot of attention being paid to internal controls in the workplace. Publicly traded companies are required by law to they're required by law to have a system of internal controls, to report on it, and to have an outside auditor examine their system of internal controls and determine that, one, it is designed properly and that it is actually in effect, that it's being followed. And that follows 5 different areas. One is the control environment. Another is assessment of risk, control of operational activities, monitoring of the control processes, and then communication of information. So we'll talk about each of these in turn. The first is the control environment, and there are several aspects to this. A lot of people will use the term tone at the top. So the person in charge of the organization, what is their attitude and perspective about internal controls? Many companies that I've worked for have had the top selling salesperson become the CEO. In that kind of an environment, top selling salespeople generally are all about making the next deal and pumping the numbers and all of that kind of stuff, and they generally view internal controls as being an obstacle to making deals happen, that sort of thing, kind of an uncomfortable necessity, that sort of thing. So when they're not wholly enthusiastic about internal controls, it can be hard to get the organization behind that. So that's one issue. The other issue coming from top management is, what is their philosophy and style of management? So do they believe in big carrots and big sticks and lots of pressure, and that's the way to get results, which a lot of companies do? If that's the case, it's an environment that's ripe for fraud if that's how it's done. The other issue is personnel policies. So are you hiring people that are qualified to do their job? Sometimes companies will, or employees will, commit fraud to cover a mistake they've made. So we're not doing anybody any favors if we put somebody that's not capable in a position where they're trying to do their job and making mistakes and covering them up, that sort of thing. One way to counter that is to have fidelity bonds on your employees. So it's an insurance policy that certainly with anybody that has access to financial matters, that insurance policy covers the company's loss if that person commits fraud. In that case, the insurance company is going to do a very deep dive on that individual. What is their background? What is their training? All of that before they issue that policy. So it's a way of kind of screening out that risk. So risk assessment gets to the fact that you're not ever done with internal controls. You can't draft it, put it in a binder, disseminate it, have some meetings about it, tell everybody what you're doing, and then think you're done. Because business changes all the time. Whether it's a private sector business or a state agency or whatever the case is, how we do things is going to evolve. And as things evolve, we need to revisit those internal controls and say, are there some controls that are now obsolete that can be gotten rid of? Or are there new controls that are needed that we need to put in place? So we always need to be looking at risks within the organization and determining how what we're doing should be changed relative to those risks. That's very important. Control procedures, this is kind of the bread and butter of internal controls. If you don't remember anything else, remember this slide. So one I mentioned before, having competent trained personnel, that's really critical. This next one, requiring absences or having rotating duties. And many companies will require anybody that's involved with the finances of the company to take 2 consecutive weeks of vacation every year. The purpose there is you want somebody else sitting at their desk, taking their phone calls, taking their emails, performing their tasks, because if somebody's doing something squirrely, if they're receiving money from a customer and depositing it in their own bank account and recording credit memos, somebody's going to call. Somebody's going to notice something on their month-end statement about why payments aren't showing up, but credit memos are showing up, and they're going to call and ask about that. Or you're going to process payroll and realize that there's a fictional employee on payroll that doesn't really exist, and that money is going to the person running payroll. You're going to come across those things if you're doing someone else's job in their absence. One warning sign: if you go into an organization and they introduce you to somebody and they say this person's been here 20 years and they've never had a sick day and they've never taken a day of vacation, your antenna should go up, right? There should be some warning signs there. Another way to get around that, if that's not possible, the required absences, is having people rotate and change jobs. It's a good thing to do anyways, from job satisfaction perspective, from if somebody quits abruptly, you have other people that know how to do that job. So there's other benefits to the organization, but one of the benefits is an internal control benefit, is somebody's going to be sitting at that person's desk doing their job. It's important to have separation of duties for related operations. So as an example, we shouldn't have one person that can issue a purchase order, receive the shipment, and sign off on the invoice being paid. Because again, that could be a purchase order for fictitious goods. The goods never do show up, but we fill out a receiving report anyways. We approve the invoice, and we get the money. It goes to our bank account when the invoice is paid. So that's one area where 3 different people should do that job. And you could say that about purchasing, as I just mentioned, or about cash receipts, or about cash disbursements. A whole variety of different kinds of jobs should be split up among multiple different people. Now, does this absolutely guarantee there can't be fraud? Well, no. We could still have collusion. We could have people working together to steal from the company. That certainly has happened before. So it doesn't prevent it from happening, but it kind of raises the bar, reduces the probability of that incidence happening. It's important to separate the operations of assets, the custody of the assets, meaning who holds the title for the vehicle, that sort of thing, and accounting for the assets, accounting for the purchase and the sale of the assets. Those should be 3 separate people in an organization. Anywhere possible, you should use pre-numbered documents. This is something that Dynamics does very well. It'll automatically pre-number documents, because then you have a log of all of the shipments that have been made, or receipts that have been made, or whatever the case is, and you can investigate anomalies or breaks in those pre-numbered documents. And then lastly, physical security measures. There should be locks on doors. There should be passwords on computers that time out fairly quickly. So if you leave your desk to use the restroom, somebody can't come and do something on your computer. All of those kinds of security measures are important. I will never be surprised at what people are willing to steal. So monitoring is a way of kind of looking at the company and picking up on warning signs. And those warning signs could either be relative to individuals in the organization or the system itself. So with regard to people in the organization, be on the lookout for an abrupt change in lifestyle. If a low-ranking employee comes to work in a Lamborghini one day, that might be a problem. There may be some issue there that would raise suspicion. Beware of close social relationships with suppliers or vendors. A lot of companies have a 0 gratuity policy, that nobody in the organization can accept a meal or drinks or a trip or Seahawks tickets or whatever the case is from an outside vendor. Now that's for 2 reasons. One is to make sure that there isn't some kind of kickback arrangement going on where the company is overpaying that supplier and the employee is getting part of that windfall. The second is to make sure that employees can objectively negotiate with those suppliers. If they have an excessively close relationship with a supplier, they're not really in a position to be able to negotiate as somebody should. They've been compromised. Again, refusing to take a vacation is often a sign that you don't want somebody sitting at your desk looking at what you've been doing. Borrowing from other employees would be a sign of a potential incentive for committing fraud. personal financial problems, and excessive alcohol or drug use can also lead to incentive issues. Warning signs from the accounting system itself: having missing documents or gaps in the sequential numbers for documents could be a sign that documents are being destroyed, or documents that relate to fraud are not being filed where they should be, that sort of thing. If there's a large increase in customer refunds, those might be not valid. Again, those should be fairly steady as a percentage of overall transactions from year to year. So keeping track of refunds relative to revenue is a good way of kind of noting that that percentage has changed. If there are differences between daily cash receipts and bank deposits, it could mean that some money that is coming into the company is being rerouted to an employee versus going to the organization's bank account. If there's a sudden increase in slow payment to vendors, there may be some issue there. And then if there's a backlog in recording transactions, it could be an attempt to kind of cover up the fraud. Now, communication, it's important that all of those first four elements are communicated to management. So it's important that upper management knows what the internal controls are, know why they exist, and any information that we glean from those controls needs to be conveyed to management. You should never assume that any instance of fraud is too minor to report. That's for senior management to decide. It doesn't matter if somebody stole $2. My general experience is that somebody that doesn't know right from wrong, somebody that would take $2 that isn't theirs and put it in their pocket, it's a slippery slope. They would also take 20, and then they would take 200, and then they would take 2,000, and there isn't a big difference between $2 and 2,000 from that person's perspective. So never assume it's too small, and never confront the person that you believe is committing fraud. Always go to one level of management above that person. So to talk a little bit about cash specifically, because that's the asset that is most likely to be stolen, that we're most concerned about. So I want to talk about cash coming into the business and cash leaving the business. So here's an example we can all relate to, because we all go to stores and buy things. So we approach a cashier with our basket of goods that we're buying, say it's at a grocery store, and they ring it up on a point of sale system or a cash register of some kind, and that register will produce two receipts. They'll receive cash from the customer, and they'll give the customer a receipt and any change that's due. So that customer is going to be given a receipt, of course. The other copy of the receipt will go to the accounting department, and that may happen physically, it may happen electronically. The cash is going to go in a separate direction. The cash doesn't go to the accounting department. The cash goes to another individual, the Treasury Department, or whatever you might call it, and they will make an intact daily deposit of that cash. Intact meaning all of the cash gets deposited. They don't hold anything out for a pizza party on Friday or whatever the case is. It gets deposited daily, intact, in full. That they take that to the bank, they get a deposit ticket from the bank. Now someone in the accounting department can compare the receipts from the cash register with the deposit ticket from the bank, and they should equal each other. They could be off by $1 or $2 because of errors in making change, but they should be very, very close to each other. If they're not, then they would investigate why they're not. You may have been to a grocery store before where they change cashiers right after the person in front of you gets checked out, and the new cashier will often bring their own cash drawer, and the cashier that's leaving takes their cash drawer, and usually they sign out of the system, and the new person signs in, and then they deal with you. Well, that's because they're doing this kind of reconciliation per cashier per shift to determine if somebody is taking money. Again, this is a really good example of removing an opportunity for somebody to do the wrong thing. Cashiers are often fairly low-paid people. They're sitting there with a drawer of cash in front of them. How easy would it be to take 20 bucks and put it in my pocket? That sort of thing. Well, if I know that this cycle is being analyzed per cashier per shift, well, then I know it's going to be fairly obvious if my till is short $20, and they're going to know that. So I'm not going to take the $20, that sort of thing. In terms of cash disbursements, the key thing is making sure that payments are only made for authorized transactions. So, one, we want to make sure any cash discounts that are available are taken, and companies will often use a voucher system to verify correctness of payment. So, a voucher system is I issue a purchase order to a supplier for goods, they show up, another person receives them, inspects them, and fills out a report that says it was complete and okay. Those two documents go to the accounting department, an invoice comes in from a supplier, and we compare that invoice to the purchase order. Is this indeed what we asked for? And is it the price we agreed to pay? We look at the receiving report. Did all of the goods come in? If all three of those documents match, then we staple them together and we pay that invoice or enter it into our accounts payable system. That's one way of making sure we're not paying for things we shouldn't be paying for. It's important that we mark the documents paid so that it doesn't accidentally get paid a second time, and then use electronic fund transfer payments whenever possible versus checks that could be altered or copied in some way.